right. So yesterday this is a NASDAQ futures chart. Yesterday was complete panic selling, and then we had another 2% sell-off overnight. So we were watching this last night. I was watching it until maybe midnight, and then I hit it and placed some orders in where I thought that an overnight bottom could be located. I used the Camarilla S3 day pivots to get into some long positions on only the micro NQ and micro ES positions or contracts, because I'm not willing to risk anything else, because it's moving around so much that you have 5-minute candles that are 10 handles of SP 500. So I'm looking at where we are right now in the NASDAQ futures, and the bottom overnight happened to tag the 200-day moving average, and we moved back up above this rail right here that is connecting back the September 2018 high with this little high right here, and it's kind of looking like it may be a support level. The fact that we hit that 200-day moving average and then backed all the way back up, this is something like, what is this? A 200-point move off of that moving average. So this could be a temporary bottom, maybe. We'll find out on Monday. No promises, because yesterday I was a day early, thinking that all of the dark pool blocks coming in yesterday were going to be buys, but they needed to spoof the entire trade and wash it out before bringing it back up again. So this is a common theme. Way back when we saw American Airlines and a TLT print, TLT had something like a multi-million print, and then American Airlines AAL had a 9 million dark pool print that happened right around here on this date, on February 10th or 11th. So they like to wash out the trade, move it up above the dark pool and then back down. I see this all the time where the price first moves in the opposite direction that it's intended to go. And I'm pretty sure that this has to do with really old fill patterns a long time ago, where they would where a floor trader would see a big limit order, and then move the price up to fill it, and then the price actually goes in the opposite direction of the intended trade. So that was back here. So big insiders knew that something bad was coming way back in January 20th. That the virus wasn't going away. Just because on February 3rd the PBOC decided to inject $400 billion worth of bonds into the markets didn't mean anything. We went up for a little bit and then came all the way back down and resumed the correction that we were supposed to do from late January to early February to mimic that February 2018 correction. This guy right here. So this is kind of the same sort of correction, except that NASDAQ is much bigger. For top to bottom, let's see. $8.7 for the close. And this close yesterday here was 12.87%. So we're doing interesting things. So if I take this, I just made this little script that I talked about the other day. If I take this guy is just showing the weekly change in percent. Or just the candle change in percent. The current candle change for the week, this big fat moving average, the yellow one, is the 200-week moving average. So if we go back in time, the only time we had a correction this big for a weekly candle was October 6, 2008. And then the second place one was September 2001. And that was, if you don't know what that date is, that has to do with planes crashing into buildings. So this is an unprecedented sell-off, and the amount of volume for this week is massive. So I'm going to look at some statistics later on this week, or over the weekend, that show, what's the average return after something like a 10% weekly candle. And 10%, I think we can look at these and see if you have a 10% weekly correction, what's the return the next week? And usually it looks like it's something floating around 5%. For a 10% correction, you get anywhere from 5 to 6% on the return. And even in a bear market, like from after the dot-com bubble, the bear market even had a weekly gain the next week that was 5% or 6% the next week. This is not including the high that it could have been reached along the way. But even in a bear market, a huge 10% weekly candle usually generates some kind of a big rebound. Bottom of 2008, not so much. We had it generated still a 4% rebound, but the high for that candle went all the way back up. It went something like 78.6% of the range of the previous weekly candle. So even the high actually got back up, significantly on that candle. So I'm gonna look at more of these examples, but I think that a 10% threshold, if we stay under this for the week, it's the amount of data points that we have could seem anecdotal, but it could be significant. I'm not sure. We'll see. We could come all the way back up to this rail that we were looking at that connects the top of January 2018. I thought that we would stop around here, but we just went straight through the 200-day moving average, which is this yellow line right here. So we could, if a 5% pullback back up, if we go from where we were, if we close here where we are right now, 5% would be this top rail back to the top. This white rail that's showing would be back to the top. So that could be what we do, or back to the top of the 200-day moving average. DAX, I thought would hold this rail. It did not. It's on the 200 weekly moving average. Let's see if it holds this. The volume is insane. I don't know. This looks like a pullback to me back up. I thought we were going to hold this area right here on this back test of this rail, similar to the S&P 500, but only the NASDAQ futures are actually holding. That this rail, they were just so strong. So remember I talked about these blow-off type curves of just complete overbought conditions, and these curves really work. I see them on all time frames, and you have a huge move at the beginning, and then a kind of a middle section. And usually what you want to see is a gradual drift up in the middle section, and then a final move up that mirrors the beginning of the move, and then just an Eiffel Tower drop off at the end. So that was kind of something that happened at the end of 2017. The Bitcoin top is around here somewhere, but this is much more pronounced because it's a complete move that started in December 2018 and ended abruptly, only a few days ago. So this is something I've seen on many time frames, just not so often on a daily time frame. VIX looks like it's doing a complete blow off. We were way up here earlier in the day, and this looks like a blow off to me. This looks like it's going to completely dump in the following few sessions and maybe come back down to 30 and hover around 30 maybe, and then slowly start to disintegrate as it has in previous corrections. We're still in a bull market. You know, don't let anybody tell you this isn't a bull market. We're only a week away. A week ago, we were at all-time highs. So this is going to have some pullback. This isn't just going to just keep going and we're going to descend forever and never correct. The volume is peaking out. So if we go over to... Oops. Let me go over to a different chart here. So on the left, S&P 500 futures, and on the right, 30-year bond futures. So I thought that we could stop right around this Camarilla R4 pivot. We went past it. I don't know if it's going to upthrust this candle and then slowly start to die off. The volume has completely peaked out as of 2 days ago. On what's today? Let's see. As of Tuesday, actually. Gold, completely different story. So that same idea that I published where we would top out on year Camarilla R4 has proved to be a really great trade. And remember, I keep showing that seasonality chart for gold that shows a relative top during this time for gold. To wait for it to load. So remember, the 24th of February statistically has a relative top over the last 10 years and sells off into the FOMC. That's not true for every year. It's just an average for all the years. So I shared this with a couple of people, and they cited 1 year that was outside of this probability, and that's just, you know, that's just silly. This is statistics. It's just averaging all of the previous 10 years. So on average, this is what we do up until the next FOMC statement, which is on March 18th. So any strength in the markets is going to bury gold. Gold, in my opinion, is going all the way back down to 1440 after hitting this R4. It's at least going to go back to the 2019 close, back to 1523. Something that's terrifying is the miners. Miners went up to year R3 Camarilla pivot right with gold and completely died. This is a classic Wyckoff upthrust. You go up, you go down, and the weekly candle, if you look at it, is absolutely terrible. This is probably going to go all the way down to year S4, in my opinion, down to $34. So this is not looking good at all. This candle structure to go like this and to completely wipe out the entire move, this is not going to get better. It's going to get much, much worse. So $34 is my target down in this area. GDX wasn't as bad, but still pretty bad. It didn't quite get up to this year R3 pivot that I thought it would, but close enough. So this morning we're gapping down slightly. I've got oil over here, NASDAQ futures, S&P 500 futures. I think that there's a possibility that we can have some kind of inverse head and shoulders here. Maybe we come back down to this level, this level right here is really important from the past. It's a combination of a few Fibonacci levels. So you've got this. Wow, there's so much stuff on this chart. Let me take this stuff off. This Fibonacci level from June 2019 up to July 2019. This pullback here is the 61.8% FIB level, and then this 2.618 extension is from the top, from this bottom here on January 31st to this top. This is 2.618. I look for confluence like this for two overlaps, and that looked like a pretty good place to take along. And then you had also the Camarilla S3 day pivot here. So let's see if we can get these. It looks like NASDAQ futures just went right up to the previous close and died. So let's see if we can get maybe a right shoulder at this location. This white trend line that's right here is the same one that is this big trend line that I showed before. So that's that same white trend line that we need to hold. I don't think there's really anything else. Miners were a great play, will continue to be a great play. Anybody that took JNUG or Nugget puts in the last couple of days, that's a huge win. VIX finally really focusing on VIX. This looks like a complete blow off to me. There's this site called VIXCentral.com that I look at sometimes, and it shows some really interesting stuff, and showed that we ended up the session at 12, or actually this is current, negative 12% contango. So contango means that the VIX spot is above all futures contracts. And usually this is backwardation. I'm sorry. This is backwardation right now when you're negative. Usually when you are in normal contango, the futures curve steadily increases the farther the expiration is away from the current expiry. And that's just because of extrinsic value like options. Options are more expensive the farther away you go out. But in backwardation, the spot price is above the futures. So the futures over time, remember that any option or any future has to have all extrinsic value removed from it at expiration. So the front month contract for VIX futures has to be equal to the spot price at expiration. And the only way that that's possible is for a gradual climb from the futures curve as you go out in time to meet the current spot price. And since the spot price is so much higher, all the futures contracts are curving up except this one that's in October, and that is because it is anticipating the 2020 presidential election, and you have this little spike in the implied volatility of the VIX futures contract for October because people are betting on a huge amount of volatility right before the election, and that's why this spike is here. This spike has been here for months. It's been baked, or not months. It's been here for 1 to 2 months since this contract existed. It's been baked in. Contango over time, if you look at the historical contango, being at negative 12% that we are today, this is a significant level. You don't get this level very often. Maybe 2011, 2015, 2018 was a big one. December 2019, that was another big area. Let me zoom in on this. This is a big level. To be down at negative 12% is a big level. So usually what happens is you'll have some kind of a correction, and then build right away back up. So you can't stay in this for long, especially when we're just coming off of all-time highs only a week ago. Usually you're going to get a fierce rebound after something like this. All right, good luck.